Hey everyone, welcome back to Corporate Decoder, where we dive deep into the financial statements of public companies to decode what is really going on behind the numbers. And today we're taking a look at VALVOLINE Inc's annual report. Now, if you appreciate getting these straightforward financial breakdowns without the corporate jargon, make sure you hit that subscribe button. And don't forget to join our Discord community linked in the description below for more exclusive content and discussions. So VALVOLINE Inc. is a company many of us know for their car maintenance services. But how are they doing financially, and what are the hidden stories within their latest annual report? We're going to dive into their financials, look at the risks they're facing, and see what their strategy really means for their future. First up, let's talk about leadership. Laurier Flees has been at the helm as President and Chief Executive Officer since October of 2023. Before that, she held significant roles at Walmart Inc. Kevin Willis stepped in as Senior Vice President and Chief Financial Officer in May of this year, coming from Ashland Incorporated, where he was also CFO. These are seasoned leaders aiming to guide Valvoline through its next phase. Valvoline's core business is automotive preventive maintenance. They operate and franchise a massive network of over 2,200 service centers across the US and Canada. Think of their Valvoline Instant Oil Change and Great Canadian Oil Change locations. They emphasize a quick 15-minute stay in your car oil change service along with battery, bulb and wiper replacements. This focus on convenience and speed is their key differentiator in a competitive market. They also support over 240 locations through their Express Care platform. A big shift for Valvoline was the sale of their global products business, now known as Valvoline Global Operations or VGO, to Aramco Overseas Company BV back in March of 2023. This means Valvoline is now focused purely on its automotive retail services. The results from that sold business are now part of what they call discontinued operations. Looking at the company's market value, the stock held by people who aren't company insiders was worth about $4.4 billion at the end of March this year. And by the 18th of November, they had over 127 million shares of common stock out there. When we look at the compensation plans Valvoline has in place, they offer a variety of stock appreciation, rights, and restricted stock units to their employees. This is a common way for companies to incentivize their staff, tying their rewards to company performance, which is a pretty smart play. Now, let's get into the nitty-gritty of the risks. Valvoline operates in a really competitive environment. They are up against everyone from car dealerships and independent repair shops to other quick lube franchises like Jiffy Lube and Grease Monkey. This intense competition can force them to lower prices, which directly squeezes their profits and can make it harder for them to grow. Another big concern is the cost of their supplies. Things like oils and other car maintenance products can fluctuate wildly in price. Think about global events, trade issues, or even weather impacting production, and suddenly their costs go up. If they can't pass these higher costs on to customers due to that intense competition we mentioned, their profits take a hit. They also carry a significant amount of debt. As of the 30th of September this year, Valvoline had over $1 billion in debt. While they have borrowing capacity available, a lot of their cash flow has to go towards paying off this debt. This means less money for investing in new stores, developing new services, or even returning value to shareholders. It basically makes them less flexible when things get tough. Plus, with interest rates fluctuating, that variable portion of their debt could become a real problem. Now, for the most important part, the financial tables, Valvoline Inc. and its subsidiaries prepare their financial statements according to us generally accepted accounting principles, which is standard practice. They're basically telling us how they are accounting for all their business activities. Let's start with the consolidated statements of comprehensive income, which shows how much money they made and spent over a period of time, and ultimately their profit for the year ended the 30th of September 2025. Valvoline reported net revenues of $1.71 billion. That's a decent 5.6% increase from the previous year, driven by more stores and higher average spending per customer. Their gross profit, which is what is left after they pay for the direct costs of providing their services like labor and materials, also saw a healthy increase. It went up by about $40 million to $658.5 million. This improvement indicates they are managing their costs relatively well, while also seeing revenue growth. The bottom line, income from continuing operations remained pretty stable year over year at around $214.8 million for 2025. This stability, despite revenue growth, might suggest some increased operating expenses or strategic investments are balancing out the top line gains. Now, let's look at EBITDA, which is earnings before interest, taxes, depreciation, and amortization. This gives us a clearer picture of the operational profitability before financing and accounting decisions. Their adjusted EBITDA, which removes one-time or unusual items, came in at $466.8 million for 2025. This is up about 5.5% from the prior year, showing that the core operations are still growing stronger. Moving to the cash flow statement, Valvoline generated $307.1 million from its operating activities in 2025. That is a good increase from the previous year, showing they are generating solid cash from their day-to-day business. However, when we look at investing activities, they spent $259.2 million on adding to property, plant, and equipment. This massive investment suggests Valvoline is heavily reinvesting in its infrastructure, likely for store expansions and upgrades. Their debt situation is a mixed bag. As of the 30th of September 2025, their total debt stood at about $1.07 billion. While it is slightly down from the prior year, it is still a substantial amount. They are managing it, but it is a constant factor influencing their financial flexibility. Now, let's quickly glance at the consolidated balance sheet. Total assets reached $2.67 billion, up significantly from the previous year, showing growth likely driven by those investments in property and equipment. Liabilities also grew, mainly from increases in long-term debt and lease obligations. Reflecting their expansion efforts, stockholders' equity saw a strong jump, indicating that the company's financial health is improving as they retain earnings and reinvest. This next part is crucial. Valvoline has identified a material weakness in their internal control over financial reporting. This stems from issues with their enterprise resource planning, or ERP system implementation. Essentially, there are gaps in their system design that could potentially lead to errors in their financial reporting going undetected. While management is actively working to fix this, and they believe their current financial statements are accurate, this is a red flag. It means there is a higher chance of mistakes slipping through the cracks. The company is still implementing remedial measures and expects full remediation in 2026. Looking ahead, Valvoline is set to acquire Breeze Autocare in a deal expected to close in December. They'll be acquiring 207 locations, but will divest 45 of them to another company, Main Street Auto LLC, for a net price of $593 million. This strategic move bolsters their presence. Particularly in California and Texas, they plan to fund a big chunk of this acquisition through a new $740 million loan. So, what is my take on Valvoline? They're showing strong operational performance and growth in their core retail services business. The acquisition of Breeze Autocare is a smart move to expand their footprint. However, that material weakness in internal controls is a significant concern that needs to be closely watched. It points to potential internal process issues that could have broader implications if not fully resolved. Their debt levels are also something to monitor, though they seem to be managing it by focusing on deleveraging post-acquisition. Overall, Valvoline is a company in a growth phase, heavily reinvesting in itself, but with some key challenges to overcome. That is our deep dive into Valvoline Inc.'s latest annual report. What are your thoughts on their financial performance and future strategy, especially considering that control weakness? Let me know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more decoding of corporate financial filings. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next one.